think it's quite interesting to see the carryover for growth and quite the disinflation trend, right? So to a certain extent, it looks like there is room for central banks to maneuver, and I think that's why the soft landing is. We avoided basically a recession or a financial crisis this time around, mostly because of very large and very profligate fiscal. And so I think it's something to rejoice for, and you look at the equity markets, you look at the earnings, everything looks rosy. But of course, the problem is the junctures are ahead of us, especially the US elections. And clearly the buffers that are being eroded by the minute. Today, everything is about fiscal again, in the US, in Europe, in my country, France, for example. So it's very interesting to see how, it looks a bit like the calm before the storm, right? So every economist actually tries to forecast the next recession. So I don't know when the next one will be, but I can see there is the sense of, sweet poison about this soft landing. And in the meantime, we have less and less room when it comes, for example, to industrial policy or to trade policy, which are really going the wrong way. So that's a bit the purpose of the report, is to nuance, to qualify a bit the current okay-ish momentum with what is coming next if we don't, repair the roof while the sun is shining.
But you've got US markets close to record highs. You've got the European benchmark around record highs, the German markets around record highs, Australia not far from record highs. But do you think that all of this jubilance in the market is going to be upset if indeed we don't get the rate cuts that the market is hoping for? Because you've got, for example, in the US, Jamie Dimon pushing back against cutting rates by the Fed. You've got Catherine Mann from the BOE also saying that perhaps the market is getting ahead of itself and expecting so many rate cuts this year. Do you think maybe that the apple cart is going to be upset over this one?
Look, I mean, yes, if the Fed were not to pivot in the summer, I think there would be some form of disgruntled markets, and starting with some of the highly leveraged with high growth potential stocks. Yeah. So I'm thinking here construction, transport, utilities, but also hospitality, some of these sectors, retail. So of course there are the risks. Yeah. And then there is, the US versus the rest of the world. I think one of my main concerns right now is what happens if the Fed doesn't pivot, because the economy in the US is still, overheating a bit. But Europe has to pivot, and then it spooks markets because, basically Europe is going first. And that has some consequences on managing stagflationary risks and really this reminiscence of the inflation being sticky in Europe, whereas in the US, it has been solved by, 101 monetary policy and hiking. So I think the US market is very special also because it's very narrow. It's really hanging on, a few stocks. The rest of the world is really because of the very good earnings season. I mean, most corporates are really delivering great pricing power and still manageable jaws effect. So they have decelerating turnover, but the cost structure is still manageable. And I think that's quite remarkable, but big is beautiful. Most of the companies that are listed are doing well because they have a lot of, market power to a certain extent. So I think the central banks not pivoting or not now would certainly hit very sectorally some of the companies that are very leveraged and that would not be able to roll over their debt, right? There is this debt redemption rule, for example, in Europe, but it would be okay. It's not that bad, even if the central banks were to pivot 3 months later. The real problem is if we see more and more geopolitics in the state of private affairs, especially protectionism and more interventionism and more climate-related policies that are detrimental to business.